Thanks everyone for being on with us today. If you're in the West Coast, you know that it's an extremely snowy day. I'm here in Spokane, Washington, and it's been just absolutely dumping snow. So it's a good thing for the kids. They were out yesterday, but not a good thing for adults because I had to shovel my little old lady neighbor's driveway like 4 times, not to mention my own. So good workout, but I'm glad to be in the office. I'm glad to be talking to all you today. So we're going to talk today about how to use a ridiculously smart but simple ETF system to deliver consistent big-time returns in all conditions with lots of compounding without being chained to your computer. Because if you're anything like me, you don't want to be stuck chained to your computer all day, every day. I'm not a day trader. I'm not a swing trader. We're more, well, excuse me, I'm not a day trader. I am a swing trader in terms of short-term positions, usually in the 2, 3, or 4 week time period. So let's go ahead and dive right in to the presentation. So this is, to boil down, this is a chart of where we are at with my ETF system as of the close of the market yesterday. So I like to provide you with timely information. This isn't stuff from, from ancient history. This is what's currently happening right now. And so you can see that, we trade 9 different sectors, and we're going to explain all this as we go through. I just wanted to give you a quick snapshot to give you the framework in your mind of what we're talking about. What we're talking about is we want to teach you how to trade 9 different sectors of the economy: the Dow, the SPY, the NASDAQ, the financial index, the oil, gold, semiconductors, real estate, and materials. And you can see in the middle columns, you can see the current results. So some of these trades are only 5 days old, but they're still up 2%, 1%, 0.5%. Some of the trades are a little bit older. Our oldest trade right now is up 33% 152 days, 29% in 77 days, 32% 142 days. So what the presentation that we're going to cover today, questions that we're going to answer is, number one, is it really possible to get above average market returns, benefit from lots of compounding in less than 15 minutes a week? 2, do you need to have a high-profile financial advisor to be able to successfully trade ETFs? 3, is buy, hold, and pray, investing in mutual funds, the only logical way to trade? And hopefully, if you're here on this conference today, you know the answer to most of these already, right? Buy, hold, and pray is not what we're going to be talking about. And number 4, do you have to become a day trader? Number 5, what's this about dollar cost averaging? Why do all conventional financial advisors talk about it, where if we're in a bear market, it's a recipe for losing money? Why only buying long for the market to go up is delusional thinking? And tons of other stuff. I have tons of questions of things that we're going to cover. I need to go fast because we have a limited amount of time, of course. But let's start at the very beginning. Slow down, Kurt. What's an ETF and why should I care? I'm highly confident that most of the people here on the call today are familiar with what an ETF is. So if you can go ahead and type a Y for yes or an N for no into the questions box if you're familiar with what ETFs are. I'm sure most people are. So a Y for yes if you're familiar with what ETFs are, and N for no. We'll wait for a few of those to come in. Okay, so it looks like most people are familiar, so we're going to go through this really quickly. Basic ETF is a fund that tracks indexes like the NASDAQ or the S&P 500. They're designed to exactly mimic the underlying the index without a lot of changing what's going on in the basket. There's no management fee. They're not trying to beat the market. They're trying to be the market. So, if you type in the ticker symbol for the Dow Jones Industrial Average, which on my platform is $DGI, you can see the ups and downs of the daily price movements of the Dow Jones Industrial Average. And then on the next slide, I show you, well, this is the ETF, the DIA, which is the Dow Jones Industrial Average ETF Trust that exactly mimics the movement of the Dow. So why ETFs? Well, you got lower expenses. They're more tax efficient. You got financial flexibility, consistent market performance, mass appeal, and here's a big one. There's more than 6,000 ETFs at the end of August of last year. So any sector of the economy that you want to trade, whether you want to trade, you think that for whatever reason New Zealand stocks are going to go through the roof and you want to invest in New Zealand, well, what a coincidence. There's going to be a New Zealand ETF. If you think Malaysia and Singapore stocks are going to do great, well, there's probably an ETF for that. So why should you listen to me? Well, quite frankly, I'm nobody special. I'm from a small dairy farming town, Preston, Idaho. If you ever saw the 2004 movie Napoleon Dynamite, that was set in my hometown, and my cousins are actually credited extras in that film. You know, I grew up on a farm. This is one of the farms that we grew up at that very end of the road in the absolute middle of nowhere. So it's not like I grew up with a silver spoon in my mouth or anything like that. But I did get lucky, and I sold my first internet company, which was a startup, back in 1998 for $11 million. And since then, I've had the opportunity to travel the world working with literally multimillionaires. You don't have a Learjet if you're not a multimillionaire. Trust me, those things are expensive. One of my clients, dear clients, was kind enough to fly me around in this Learjet. And, you know, I've spoken at stages all over the world, events in the UK, Australia, Singapore, Malaysia, Russia, Costa Rica, India, of all places. And have been featured in best-selling books like Nudist on the Late Shift, How to Get Rich on the Internet, and Click Here to Order. So if I'm anything like you, which I think I probably am, most of us don't really have the problem with making the money. Most of us here on this call today are probably some sort of professional, a dentist, a CPA, or a small business owner. But every time I personally have turned my investment dollars over to others, it's bombed, right? I find this some financial advisor who touts the last year that all of his clients made, 25, 30, 50% or whatever in the bull market. I turn my money over to them, and what a coincidence, that year they make 5% or 0 or negative. So have any of you ever had that experience? I'm sure that most of you had. But on the flip side, I had zero desire to day trade or be chained to my desk or to do anything super risky. I mean, this picture kind of sums it up. I really only have two main interests, and if you're anything like me, a gazillion side interests. I love to travel. This is the part of the world where I live in, the Pacific Northwest, and so it's absolutely gorgeous. This is my kids out on our boat and the lake where we have a place that we go in the summer. But I like traveling all over. This is a volcano erupting in Guatemala and Tikal and the hills of Guatemala. And just the opportunity to travel, the opportunity to spend time with my family, the opportunity to make money while I'm doing these things, to me is one of the most important things. So besides travel, having my family, my wife and my 3 kids is my main goal. So my investing has to meet my goals. And my goals are to spend more time with my family, to have money to travel, and to make way above market returns with lots of compounding in less than 15 minutes a week. So show me the money. What's the results of the system? I'm going to kind of give you 2 kinds of results. The first results are the mind-boggling one. These are the ones that go all the way back 10 years. What if we started from day one, late in 2006? We've been trading this system for 10 years now, and we put $10,000 into 90 ETFs. What would happen? Then I'm also going to show you some more recent history. Well, what if you would have just started just last year? Okay, so if you went back in time and started back in 2006, put $10,000 in each of the 9 ETFs, that $90,000 would have turned into $24.5 million with compounding. That's a 27,000% return, or 273 times X on capital. So obviously with compounding, what we're saying is we place the money in the trade, and the trade wins 10%. Well, we place the original capital plus the 10% in the next trade, and that trade wins 5%. Well, we place that capital, the original capital plus the 10% plus the 5%, and you see that very quickly the returns of the system can compound very quickly. But what if you didn't want to do any compounding and you just wanted to take out all the profits and take your profits off the table? Well, simply with that, you would have turned $90,000 into $600,000 nearly, with 0 compounding, which is still a 5.6 return. Now, what about recently? What are we doing currently? So this is for the last year on the Dow Jones. This is the number of signals we got in the last calendar year of 2016. So you can see the arrow showing where we went short, where we went long, and you can see, pretty much almost every trade was a winning trade. In this system, the current win rate is about 85%. So here's what it looks like on the Dow for last year. So if you would have been comfortable going short and going long in those positions, you would have fit in very well with our system. S&P 500, a lot the same. NASDAQ. Banking's even better because there's more trades. So you look at that initial big short trade, a shorter term long trade, another short, a long, a short, a long, and each of those times we're pocketing that that win, putting that into the compounding in that individual sector. Oil trade, this is probably our best overall sector. We actually kill it with the ETF tipping point in oil. It works very, very well with extremely high accuracy. Gold, same sort of thing. Not as many trades on gold, but you can see some of the trades from last year, right there. Semiconductors, real estate, and materials. You know, so to boil down, here's in a in a text format, here's exactly what it looked like last year. So we're up 16% on the Dow, which isn't great. You know, it's not a great year for the Dow. 62% on oil, 35% on gold, 33% on financials, 14% on the S&P 500, 15% on the NASDAQ, 40% on semiconductors, 26% on real estate, and 23% on materials. Now, this is all based on just the single ETF, of course. This is, and we'll talk more about that later. So how do we generate these tipping point signals? Well, by definition, technical analysis is 50 years of traders arguing about the stuff that works sometimes. If you go to Amazon and type in the phrase technical analysis, you're going to come back with 50,812 results for books about technical analysis. So there's no shortage of opinions or advice about technical analysis. So I'm going to give you my controversial statement for the day. Moving averages suck. Moving averages are the most commonly used technical indicator. So even Larry Williams, who I love and I love his work, he's filled dozens of books with 60 or so different oscillators for trading. But you know, shouldn't there just be one that works by now? The answer is that technical study by itself doesn't do it. We're all looking at the same data. The problem is any technical study is really only looking at three basic elements, and those elements are price, time, and volume. That's it. Now, of those three, how many of you would like to venture guess, if you looked across every technical study, every technical analysis tool, which of those two out of the three are the most used to come up with new indicators? Is it price, time, or volume? Which of those two are the most used, and which is the most neglected? Go ahead and type that in. Think of the indicators that you use. What do they use? Are they using price, time, or volume? All right, go ahead and type those in. Well, most of you are getting right. Most indicators are going to use price and time. Volume is kind of the red-headed stepchild. So everyone scrambles to put their name on a proprietary indicator, but the real failure of all of these is they all use moving averages. It doesn't matter what kind of technical instrument you're looking at. If I go to Investopedia and look and type in technical indicators, you're going to get over 600 different technical indicators. You know, blow off top, death cross, fake out, gravestone doji, kicker pattern, multiple tops, red candlestick, you know, and it goes on and on and on. And you know, if even newbies know that most of these are based on some form of a moving average, and that moving averages by themselves, it's not that they don't work, they just don't work all the time. But the problem with this is, if you do that, you're following the pack, and as most of you know, the pack is invariably wrong. What we're looking for is something that it's illustrated by this simple drawing. We're looking for something that what we call the tipping point. We're looking for something that gives us a heads up when the market is about to change without a ton of work. We're looking for something that can get us there. You know, if we start on the left side of this hill, the Sisyphus effect, right? That's the Greek story of someone pushing the boulder up the hill, and obviously it slips and slides and rolls back down every time the pusher takes a rest. But then when we get to the very top of the hill, we're looking for something that just works. It's reliable. It provides valuable intelligence for the trades, and it has a high probability. We're looking for that tipping point. So what do we do? What is this ETF tipping point that I've been alluding to? How do we use it? How is it different than any other technical indicator available on the market? Well, first off, we only start with stocks and ETFs that have options available on them. And I advise you to do the same. No matter where you look, it's been proven that stocks that have options available on them have much more investor interest, which equates to a better trading vehicle. Number two, as we look at all the ETFs, which could be a mishmash. They could either be price-weighted ETFs, market cap-weighted, or equally weighted. We're going to cut to the chase and say the only fair way that we found to sort through this noise is to make them all equally weighted. So that means in the S&P 500, just as an example, most ETFs are either weighted by the price of the stock, right? So a stock that had a price of 200 versus a stock that had a price of 20, the 200 is going to have much more weight. Well, how is that fair, right? I mean, there's stock splits all the time. There's all kinds of things happening. The price of a stock is irrelevant to the size of the company. So, you know, some of them are market cap weighted. So a company like Apple obviously is going to have a big weight in the index than some small rinky-dink company that's also in the index. But in our opinion, when you're looking at these entire sectors and the facts prove it out, the only sensible way to treat all these is to equally weight them. So the next step is going all the way back to 1963. In 1963, Joe Granville wrote a book called New Key to Stock Market Profits. And it's insane to think of, but this idea actually works. In 1963, he came up with a concept that was absolutely genius, and the first of its time to use the volume figures that were commonly available to make trading decisions. So what he did is he came up with the concept of volume precedes price. And if you could boil down the ETF tipping point into 3 words, it would be that: volume precedes price. So Joe Granville's original idea was very simple, very rudimentary, and very basic, but also effective. Here's what it was. All he did was he created a thing called on-balance volume, which is a simple indicator. It's available for free in any trading package. This is the core of what we developed with ETF tipping point, but it's just the germ of the idea, and we'll explain how it evolved. So the on-balance volume is a simple indicator that adds a period's volume when the close is up and subtracts the period's volume when the close is down. And that's as basically as simple as we put it. However, the problem is remember, this came out in 1963. So let's take a look at what has happened to computer processing power since 1963. So when Joe Granville came out with this in 1963, they only did this calculation on big markets like the Dow Jones at the end of the day. They ran the calculation once a day because that's basically all the computing power that they had. And in 1963, if any of you were alive and aware of computing power back then, I mean, you can see that we're talking transistors, the IBM 1620, the Datamax 1000. You're talking computers that filled entire rooms to do what we do on an iPhone right now. So if you look at the rise in computing power from 1963 to today, it's immense. It's exponential. So because they were only doing this calculation once every day at the end of the day, it's kind of easy to lose track of what's really going on. So what we developed was our ETF tipping point. So what we do is we look at every single stock individually that makes up the entire ETF list. So for example, in the S&P 500, I keep a running total throughout the day as to whether there's more buying than selling going on every single trade, tick by tick. So this is your pop quiz. How would we know, excuse me, whether there's more selling pressure or buying pressure on every single trade, tick by tick? If you want to type in an answer into the questions box, we'll see if someone can guess it. Remember, we only have the same basic figures to work with: price, time, and volume. How are we going to figure out if there's more buying or selling pressure going on in every single trade, tick by tick? Well, we'll answer that here in just a second. So we're doing this on the entire S&P 500, for example, so on companies like Berkshire Hathaway, Caterpillar, ConAgra Foods, Dollar Tree, General Motors, Hormel. We're looking at every single one of these stocks. Obviously not like on a home computer or laptop, but on a server-based system that's looking at every trade that happens on every single one of these S&P 500 stocks: Zion, Zimmerman, Yum Brands, Yahoo. And what we're doing is we're analyzing whether the sale, the last trade went off at the bid price or at the ask price, right? because every time a trade goes off, a trade is settled, is going to either be closer to the bid price or closer to the ask price. So we evaluate that, and if the sale went off closer to the ask price, then the sellers were willing to hold out for a higher price, and buyers were willing to pay extra to ensure that they got those shares. Conversely, if the sale went off at the bid price, then it was the sellers who were willing to move their prices down toward the buyers who were in control. So to put it quite simply, the bid-ask spread, the bid is the price the buyer is willing to pay for a stock. The ask is a price the seller is willing to sell their shares. And right in between there is what's called the bid-ask spread. So every trade that happens on all of these stocks has a price, has a set price that it happened at. Was it closer to the bid price or was it closer to the ask price? So what this allows us to establish is whether there's an undercurrent, an underflow of volume that's bullish or bearish, regardless of the price. So at the end of the day, for example, at the S&P 500, we know how many are on a positive footing, greater than 50% with real accumulation, how many are in negative stance. Notice that this is all done without the use of a moving average or any commonly available indicator. So seeing as how we've been collecting this information over the prior 13 days, we know where each company sits in terms of positive or negative trend. So that's the whole process in 3 simple steps. At this point, I am going to assume that you've decided to forego the development of your own tick-by-tick collection platform and you would like to use our signals. If not, feel free. It took us a couple years to get this right. Ongoing data costs, of course, over $1,000 a month and well over $95,000 in programming over the years, but some folks just like to do it themselves, and that's perfectly fine. Here's exactly what we're doing. We watch for, here's what our members do. They get a signals notification that comes out weekly on Fridays, right before the market close. You can trade the next day that the market opens, typically Monday, if you can't see or make those trades on a Friday afternoon, but you lose a slight advantage. Then we show you how to buy or short the one-time ETF or the single ETF, or you buy the 2 times ETF or the 2 times inverse ETF, or you can, of course, buy calls or puts on the single ETF or buy calls or puts on the double ETF. Then we hold that position until you receive a signal to reverse or rarely go to cash and re-enter the trade the next Friday. An ETF is either bullish or bearish in this system. We try to be in the market at all times. If you're only comfortable playing to the upside, well, then only trade when bullish and go to cash for that ETF when you're bearish. So every Friday at around 12:30 Pacific time, 3:30 Eastern, you'll get sent an alert that gives it the status of where those signals are at. Then simply, we do it again a couple hundred more times. So far with this system, we've done it 624 trades in the past 10 years for an average of 5.2 trades a month. Now, the breakdown of the monthly trade gain is about 4.7% per sector per month. So as you can see, like we mentioned, this is our trade signal as of yesterday. So if you've been with us for a period of time, these are the trades you've been in. So if you joined us a week ago, you'd be in the DIA trade up 0.38, the SPY trade up 0.85, the Q trade up 2.66, the gold trade up 2.13, the IYR trade up 1.16, XLB up 1.52. Now this is in 5 trading days, just trading the single ETFs. Of course, if you traded the double ETFs, which we show you there on the chart, you would have bought the DDM, the SSO, the QLD. Your returns would be approximately double that. Of course, the double ETFs work the same. If you have a negative trade, you're going to be approximately double the loss. But of course, we also will give you the options. These are the options trades that we recommend at that point in time. We've got a lot of trouble to find the best option for you. We use our proprietary engine. And notice the way that we like to trade, more on that later. Basically, we're looking for options that are 4 to 6 months out that have a delta of about 70. So we're not looking for super speculative options. We're looking for options that very quickly can be a proxy or a replacement for trading the underlying ETF without putting up all that capital. So our preferred method is to use the options on the double ETFs. Of course, when we're talking about double ETFs, they don't always perform double the single one-time syntax, but they do perform better. So simply put, for those who have not traded options before, some words of caution and encouragement: done properly, I believe that options actually carry less risk than underlying stock. Now, there are tons of courses out there that teach you, basically how in options how to lose your money less slowly. Now, in the options market, most newbies never reach 6 months into the market. 93% of people never trade an option again, giving up their dreams of easy riches. Options trading is not easy riches. We've got to do this very strategically and in a very calculated fashion. Of course, I've been trading options over 20 years. We'll still be there. And in a game that has 93% losers, that means 7% of the traders are keeping all the money. And of course, that's where we want to be. So how do people go wrong when they trade options? Well, initially, everyone is obsessed with the fair value of the option as it approaches expiration. You're taught to look for cheap, mispriced options. That's not what we're looking for. We're not looking for mispriced options. We couldn't care less if an option is mispriced. We don't want to hold it to expiration. We only want to rent it and then sell it to somebody else so they can hold it to expiration. Like we mentioned, we typically buy options that are 4 to 6 months from expiration in the money, typically with a delta of about 70 to 75. So by renting the stock, by buying options this way, we can use the option as a proxy for the stock and get the gains without the obligation. So the main thing about options is do not overinvest. What we typically recommend for each $3,000 that someone puts into a sector, you can go ahead and purchase, if you want to juice up your returns, one options contract, which is going to cost about $700 to $1,200. If you're going to do the 2 times ETF options, for every $5,000 you put into the sector, you can go ahead and, in addition to that, if you have the available capital, purchase 1 options contract. So what we're saying is do not overinvest. We also have what are called our best of class buying. So what that simply is every time that we're looking at these ETFs, we're looking at an entire sector. The Dow Jones, which is the Dow 30 stocks, the S&P 500, the 500 stocks that make up that. But in any one sector, there's also going to be high flyers and laggards in that sector. So the question that we have is, well, how could we purchase the best stock within a sector without buying the dogs, right? So what we do on that, and we'll show you exactly how that works, is inside the ETF tipping point, we break it down. We show you, here's the stocks inside the Dow, here's the performance of the Dow against itself, and here's the high flyers. You can see the red circle at the top. At this point in time, it was IBM, Microsoft, and Pfizer. So now instead of buying into some of the losers of index at this time, which is Bank of America, Caterpillar, and Alcoa, we could just buy either the stock of IBM, Microsoft, and Pfizer, or the options on IBM, Microsoft, and Pfizer. So we want to spread a risk around. So in this case, we would buy 2, preferably 3, in case one of the high flyer gets in trouble. So I still advocate, buying more than one of the leaders in case one of them has a slip up. You're generally going to see 15% better gains using the best in class as opposed to simply buying ETFs. It is a little bit more time consuming to track. However, it does give you some slightly better gains. Of course, this system is normally too volatile to chase, and there's not any time to wait for confirmation. You'll notice in our closed trades list, which we publish to every member, that the average trade length is about 12 days. But there are quite a few trades that are, that are shorter than that. Right now, we're in a board, a rise across the board, which is market-driven, not sector. Usual legal stuff our attorneys make us say: the financial markets are risky, investing is risky, past performance does not guarantee future performance. This has been prepared solely for informational and educational purposes, not solicitation or offer to buy or sell any security. So who might be interested? So here's where we find out if you're interested in taking us up on this. Again, here's the kind of trades that we're looking at. Last year on the Dow, in one of our 9 sectors, you would have made a total of 1, 2, 3, 4, 5 trades. But those simple trades have immense power because we have a high probability, a high win rate, 85%, and we teach you how to do the compounding. And so if you would have started with this 10 years ago with $10,000 into the Dow, you have turned that $10,000 into nearly $425,000 with compounding. Just from these simple trades. S&P 500 last year, 4 trades. But if you would have started 10 years ago, that $10,000 would have been over $450,000. The NASDAQ, same thing. Your $10,000 would have been over $1 million. Banking, few more trades last year, 1, 2, 3, 4, 5, 6, 7, 8 trades last year. Banking in 10 years turned 10,000 to 3.5 million. Oil is the big one. Lots of trades on oil. Last year, 1, 2, 3, 4, 5. If you would have gone back 10 years, so basically take this screenshot and multiply it by 10. So I'm not talking tons and tons of trades. We're not talking, dozens of trades a month or anything. We're talking 5 or 6 trades per sector per year. And on oil, that would have turned $10,000 into $12 million. That's the power of compounding. Gold, same thing, 10,000 into 450,000. Semiconductors, 10,000 into almost 3.5 million. Real estate, almost over a million, almost 1.2 million. And materials, simple, boring sector, right? Building materials. How exciting is that? An ETF about building materials, but it turns $10,000 into over 1.7 million. Like we mentioned, our monthly system results, the boiled down number, if you're saying, well, how much on average can we expect the return per month? Well, it's 4.7% per month. That obviously, that has a lot of variance in there. Some months you can have negative months, you can have very positive months, but on average, month in, month out, it's going to be 4.7% a month. So here's, again, some of the trades from last year, from 2016. We're into brand new trades on 2017 that don't show up on this yet, but we have some current winning trades that are very profitable. So if this is the kind of thing that you're looking for, obviously oil is a great sector, finance is a good sector, gold's a great sector, and these numbers don't take into account the compounding. So even though, say on SMH it shows, well, let's wait for the little video to stop and we'll give an example. So take a look at oil. That's the second one. It's going to be hard to see. I don't have anything to circle it. Sorry about that. But oil is the second market down. You can see the net return was 62.98%. That's just the simple return. That's just adding up the winning and losing trades. If you look to the right, it shows you what it would be with compounding. If you started with $10,000, how much would you end with? You would have turned $10,000 into $18,045, which basically means you got a return of 80.4%. So you got 62% from the trades and then another 20% gravy from the compounding. That's the real power of this system. So again, here's what the trades look like currently. We're not talking super sexy. We're not talking, huge gains per day or per month. But, if you stick with us, I think most people would be happy to make 29% return on an oil trade that's lasted 77 days, if you look right there in the middle of the chart. So does anybody have any idea what this is? Any guesses? Any guesses? Go ahead and type your guesses into the questions area. That's right. It's a hill of beans. That's what all of this amounts to, unless you're going to take action. You need to take action. Like I mentioned, I'm nobody special. Wasn't born with a silver spoon or anything even close to that. I've learned and studied and invested to be able to develop this system. So I want you to invest with me. So here's my offer to coach 25 of you. We have 2 program options. The first one is $997 for 6 months access to the signals, or $2,997 for 3 years access, which is a 50% discount. Because quite simply, I hate overhead. I could hire some fancy marketing and get some full-time sales guys, but that's just not me. This is my simple office here in the branded advertising building. You can see my sign there, Trading Science. I've been in Spokane for 14 years, not going anywhere anytime soon. We have open office hours. We do occasionally have customers drop in, and we're happy to have you. Give us a heads up. We're at 122 North Raymond, Suite number 1 in Spokane Valley, Washington. And we run a simple lifestyle business. I'm not in this to be a hedge fund manager. I'm not in this to work 70 hours a week. So instead of dealing with big wigs and hedge fund managers, I'd rather enjoy my free time and deal with just a few customers. And so here's an example. This is one of our customers, Dean.
My name is Dean Hamill. I live close to the city of Florence in Oregon. I've been trading using the ETF tipping point strategy for about 8 months. and I am more than satisfied with the results, some of which I'll share with you in a moment. Over the years, I've tried many investment advisory services, newsletters, and tried many different investment strategies. The results with all of them have been less than stellar. For years, I've been looking for a strategy that is easy to follow, easy to execute, low risk, and of course, most important, significantly profitable. After my first few tipping point trades, I became convinced that this is what I had been looking for. Now I'm going to quickly recite for you just a few of the results of my early trades. Some of them are very impressive and some less so, but the overall result is very exciting and very profitable. I'll tell you first of all the percentage gain and then the number of days in the position. 9.49%, 64 days. 9.19%, 64 days. 10.51% in 54 days. 6.81%, 62 days. 4.41%, 63 days. 16.21% in only 36 days. Out of the 37 trades I've been doing, 32 were winners and only 5 were losers. This is a very impressive track record. Another feature I like about ETF Tipping Point is that it takes so little time. I just wait for the daily instruction. Most days there's no change, and so there's nothing that I have to do. When a signal does come, it takes only a few minutes to execute, and then I'm done. My personal experience has convinced me, and I recommend ETF Tipping Point without reservation.
So I'm willing to put my money where my mouth is on this, and I'm going to take the majority of the risk by giving you an ironclad 2-part performance guarantee. Very simply, part 1, go through the entire training, start trading live or in demo mode, and if you don't love it, get a complete refund anytime within 90 days of ordering. Simply submit your trading log and we'll issue a prompt refund. So all we're asking on that is, if you do buy, do it, right? And we're not even saying you have to use real money. You can put an account in demo mode or paper trade it, and if you don't love it, get a complete refund anytime within 90 days. Simply submit your trading log of which trades you took with the timestamps from your trading platform. We'll issue a prompt refund. Part number 2, learn the system, use it for a full 6 months, executing all the trades that come up. If you don't at least make the system investment back, $997 for the 6-month option in profit. I'll personally work with you for free until you do. So either way, you love it, you make good money with it, or you hate it and you get your money back. I don't think we can be much more fair than that. So we have several more testimonials, but in the interest of time, we're going to skip through those. Quite simply, this is from John Lilly, one of our customers in Washington. He created his own little spreadsheet to keep track of his trades. He's currently up 44%, so he's super ecstatic about the system, of course, as well. But the interest in time to make sure that we explain everything and get to the frequently asked questions at the end, we're going to keep going. So there is some bonuses for the first 25 people to sign up. Number 1, we're going to make a donation in your name to kiva.org. Number 2, you're going to get our 2-day live workshop in Spokane, Washington. There's a typo in that. We did have one in the fall of 2016. This would be for the one that's in the spring of 2017. So kiva.org is an organization that helps third world entrepreneurs. And so we're making a donation in your name. Every time somebody orders, we use some of that funds and sponsor an entrepreneur in a third world country. So it's a great thing, something that we've donated thousands upon thousands of dollars to. And it's very satisfying to see the progress and to see what these people are doing. We're talking loans to buy cattle, loans to start a little shoe store, things like that. So that's a bonus that you get. And the 2-day live workshop, of course, can be held in the spring of 2017 here in Spokane, Washington. So to claim one of the 25 spots, the first thing you need to do is either call our secure voicemail line at 509-720-7867, leave a detailed message with your full name and address, phone, email, and credit card number with expiration, along with a choice of which of the 2 packages you'd like, either the 997 or the 2997, and we'll return your call ASAP to confirm and process your order and answer any questions. Or you can order online by going to etftippingpoint.com/6month or etftippingpoint.com/3-year. So the way that it works, we have a lot of people that ask, okay, so I'd really like to get started with the 3-year package for the 2997, but I'm just unsure if this is for me, if this is the right kind of trading, this is the kind of trading that I'm interested in. We have a lot of people that ask that. So what we do is tell you, go ahead and buy the 997 for 6 months, and if at any time during that 6 months you want to upgrade the 2997, which happens all the time, we'll go ahead, you pay the difference without any penalty, right? You pay the difference of the $2,000, and we'll upgrade you at that time with no penalty. You get all the same bonuses that we give to our 3-year members at 2997. So again, 6 months access for 997 or 3 years for 2,997. Now, to entice you to go ahead and go with the 3 years right off the gate, what we are going to give you is our weekly option science program, which we sell every day for $500. You get that as a free bonus for joining us at the 2997 level. We also have our 2-day advanced options workshop that we held a couple years ago that we charge $5,000 in admission to. We give you that for free as well. And we give you some of our ETF bonus trades, which we have our 9 core sectors, but we also give you some bonus trades on other ETF sectors as they come up. So here's some examples of some of the bonuses. This is a Kiva loan that we made in Costa Rica. This is a shot from one of our last workshops held in Spokane. We held them at the Davenport Hotel in Spokane. It's an absolutely gorgeous facility. They've spent $30 million renovating it. Very, very, very top-class hotel. So again, to claim one of the 25 spots, call a secure voicemail line at 509-720-7867. Leave a detailed message, or go online at etftippingpoint.com/6month or etftippingpoint.com/3-year. So we had a couple of other testimonials. We're going to skip this. This is from Ken Moore. But Ken actually takes us inside his trading account, shows us live trades that he's placed using the ETF tipping point system, which is pretty cool. I'm glad we got him to do that, but we don't have time to go into all the details. But the simple takeaway is, no matter if you've traded before or not, this is something that can work for you. So to answer our frequently asked questions, we have about 15 minutes, so I'm going to have to go through this kind of quickly. Frequently asked questions: what about Brexit, the flash crash of 2010, the recession of 2008? Question number 1, so what happens in these big market drawdowns? Number 2, what's the system's win rate, drawdown, and profit per month? Well, quite simply, here's the profit per month is 4.7%. You can see in the bottom right-hand corner. The total system drawdown, the worst drawdown was on oil. We had a 17% drawdown at one point in the system over the last 10 years. Most of the others are 14, 9, 5, 8. Very normal, nothing crazy. And you can see the average trade days, 38, 38, 42, 39, 41, and the average profit per month. So the most profitable sector was oil, 7.38% per month. The next most profitable was the financial at 5.83, and then after that was semiconductors at 5.39. So the question was, well, what about those? What about the 2008 and the market sell-off? What about Brexit? What about the flash crash? Well, we'll show you some examples. So here's the SPY trades on the S&P 500 in 2008. So in 2008, as the market's tanking down, we were short. We went short as of June 13th, and we're short all the way until the day after Christmas for a 56% gain. So while everybody else is losing money, losing 50%, we made 50%. What about the flash crash, which happened on May 6th of 2010? I was trading that day, as I know many of you were. Well, prior to May 6th, we were short as of April 30th. And so while that day was extremely chaotic, in our system it was pretty much a non-event. We actually made some money. We were short from April 30th all the way till July 16th, so that trade was up 11.4%. Well, what about Brexit that just happened June 23rd of 2016? Well, we were short the SPY at that time as well. So even though Brexit turned out to be pretty much a non-event, that was a marginally profitable trade at 0.07%. The other frequently asked question is, what kind of experience do I need to start? Well, answer is, you just have to have a desire to learn, a basic trading account, and a commitment to make the trades. Can I trade in a 401, in an IRA or 401k? Yes, as long as you are not trading short, you can't go short an ETF in an IRA or 401k, but you can trade the double ETFs in those situations. You can't do anything that involves a margin account. How much startup capital is needed? Well, the answer is pretty simple. We recommend at least $500 per sector. That's the absolute bottom minimum, right? Or $4,500 to trade all 9. With less capital than that, you're just going to need to trade fewer sectors to build up the account. And the big question that we get all the time, so what's this? Well, that's a tropical island, of course. So the question is, Kurt, why aren't you retired on a tropical island somewhere? Why are you selling the system to us? So think about this. Even if I had 1,000 students and they all had $100,000 invested in the SPY, for example, right? That's close to 500,000 shares, which if you do the calculation, which would be 1/2 of 1% of the total daily shares traded. And we're nowhere even close to that. I don't have 1,000 students and they don't all have $100,000 invested into the SPY sector. So that's the reason. So for me, is there any faster way for me to grow my own trading account than to make frequent deposits to further the compounding? So from one day to the next, for example, today if I sold 25 students at 997, it won't affect the results at all, right? We're talking about these massive ETFs. We just showed you the example. But it would allow me to put an additional $24,926 in my trading account. Why wouldn't I do that, right? How many versions has the system gone through? Answer, we're currently on version 4. On version 3 and prior, now we refer to as legacy, we average 3.41% per month with live trades delivered in real time. Version 4 looks to be even leaps and bounds above the prior version, specifically in win rate, and those results are marked as backtested. We have third-party audits of performance. As of October 7, 2016, we'll be both using Timer Track and offering brokerage statements as proof. On the legacy version of the software, real-time trades were delivered to members starting in January 2007 until October 7, 2016. You offer a money-back guarantee? Yes, of course. Go through the entire training, start trading live or in a demo account. If you don't love it, get a complete refund anytime with 90 days. The caveat, simply submit your trading log and we'll issue a prompt refund. Part number 2, learn the system, use it for a full 6 months, executing all the trades that come up. If you don't at least make back your system investment, $997 for the 6-month option in profit. I'll personally work with you for free until you do. Well, folks, that's as simple as we can make it. Let me go back to the order page. So if you want to place an order, that's what you do. Call the secure voicemail line 509-720-7867 or order online etftippingpoint.com/6month. We do have a few minutes for questions. We've got about, looks like about 5 minutes for questions. So if we have any questions, we'll go ahead and take those as they come up. Let me look in the questions area, and I'll answer those as they come up and make sure that we get every question answered. So here's a question from Bill Bowers. He says, are there problems with multiple as in 2x ETFs, bearish ETFs held due to daily resets? I haven't personally bought these, but read you can get beat up on these daily resets. So what he's referring to is a single ETF has a pretty simple job, right? If you're a single ETF that is the S&P 500 ETF, someone gives you money, you put it into all 500 stocks in the S&P 500. End of story. Go out and go golfing, right? The problem is a 2x ETF or a 3x ETF or a 4x ETF. Now you'll notice that we only use 2x ETFs because at this point in time, they're the most stable and have the smallest bid-ask spread, and they're not as sketchy as the 3X or the 4X ETFs. By sketchy, I mean what we're talking about with this daily reset and things like that. Because the 2x, 3x, and 4x ETFs, they're trying to make a trading decision because they're trying to do, if the S&P 500 is up 100 points, the 2x ETF is trying to go up 200 points. The 3x ETF is trying to go up 300 points. So how are they going to do that? Well, they have the core holdings, but then they have to buy and sell options, futures, and other vehicles to try to juice up the returns in that direction. So because of that, their trading costs are higher, and you have these decay, so to speak, where it doesn't, it says that it's a 3x ETF, but if you hold it for long enough, the results are nowhere near 3x. So the more X that it is, the shorter period of time you're going to want to hold it. So in our scenario, holding the 2x ETFs for a period of 20 to 30 days is not a problem. This is from BC Chan. Can you show some examples of your entries and exits? Yeah, we can go ahead and pull that up. Let me go back to one of those real quick. Well, we'll just take it random. So here's real estate last year. Real estate last year, we went short near the very beginning of the year. So, you know, January, first day of January, we were short. And you can see how the market immediately tailed off, came back, and we went long right here. That looks like that's about end of February. So we're long at the end of February. All the way to here, we were short in the middle of June. And then we were short only on a week. Made a little bit of gains there. Then long to here, and then short for the rest of the year. So that's pretty representative. You know, some of the sectors, like for example, oil is going to have more trades. Here's all the trades on oil last year. You can see where it was cycling kind of up and down. We picked the tops and didn't exactly pick the bottom there, of course, but picked the bottom there and on this nice. And this is the current trade that we're in. I think it started on 923 and we're up about 30% through currently. So go ahead and if you want to see a current trade that we're in. On oil, we entered on 923, and you can see where we're at right now. On oil, by oil, I mean the OIH ETF. This is from Harold. He says, do new versions have to be bought, or do we get those automatically? You get those automatically. Just for the interest of transparency, we need to tell you we're on the 4th version of the software. We have all the prior trades. Everything's logged and cataloged. But, you know, just like if you buy Microsoft Word, there's going to be updates, there's going to be tweaks, there's going to be improvements. It doesn't revolutionarily, you know, nothing changes in terms of how your trades are executed or anything like that. Just the settings are a little bit more refined. In this case, on the most recent update, the win rate went up dramatically. So now we're at an 85% win rate. All right, well that about covers all the questions we have. So again, if you would like to order and take us up on this, you know, we are extremely confident that this will work for the vast majority of people. That's why we offer, you know, this pretty much, you know, prove it guarantee, which is, hey, just give us $1,000, go through the signals, place the signals in at least a demo account. You don't even need to place them in a real account. And watch what happens, and you're going to become a believer very, very quickly. So call our secure voicemail line 509-720-7867 or etftippingpoint.com/6month or etftippingpoint.com/3year. All right, that's about it. Hey, thanks everyone. Thanks for being on. You've been a fabulous audience.